wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 217, and in this episode we are reviewing the performance of the financial markets during the 24th week of 2026, and that is from Monday the 15th to Friday the 19th of June. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where in his first meeting as the Federal Reserve Chairman on Wednesday, Kevin Walsh voted in unison with the rest of the committee to keep interest rates on hold for the time being, with most members signaling a possible rate hike later this year. The Federal Open Market Committee voted unanimously to keep its benchmark overnight borrowing rate anchored in a range of between 3.5% to 3.75%. The federal funds rate has held at this level since December last year, after the central bank effected 3 consecutive rate cuts in the later part of 2025. However, the new chairman declined to participate in the closely watched dot plot grid, where Fed officials share their outlook on the future direction of interest rates. Walsh has been a critic of this forecasting tool, as well as other forward guidance out of the committee, including projections on unemployment, inflation, and the gross domestic product. Over to the United Kingdom, where on Thursday the Bank of England voted to keep its benchmark policy rate on hold at 3.75% as policymakers continue to balance between the need to contain inflation and the desire to stimulate economic growth. The decision to hold came out in line with market expectations and was backed by 7 out of the 9 Monetary Policy Committee members. This decision comes on the back of higher energy costs due to the war against Iran that has pushed inflation higher, especially for economies like the UK, which is a net energy importer and therefore vulnerable to energy price shocks. The rate of inflation in the UK held steady at a cooler than expected 2.8% in the month of April, and this was attributed to a regulated energy price cap that is expected to rise by 13% in the near term, driving UK energy costs to a 2-year high. Staying in the United Kingdom, official data released by the Office for National Statistics on Wednesday showed that inflation in the UK held steady at 2.8% in the month of May, coming in slightly below market expectations of 3%. Inflation had cooled down to 2.8% in the previous month of April, and this was mainly attributed to a change in the UK's regulated energy price cap, which was expected to be short-lived, given that this price cap is due to rise by 13% in the next few months. The UK's rate of inflation for May fell below the Eurozone's rate of 3.2% and was also well below the United States inflation rate of 4.2%. And over to China, where China's retail sales fell for the first time in more than 3 years in the month of May, and this is likely to pressure the Chinese government to roll out significant stimulus to spark consumption, even as de-escalation in Middle East tensions offers some relief in the near term. According to data released by the National Bureau of Statistics on Tuesday, retail sales, which is a measure of consumer consumption, declined by 0.6% in May compared to the previous year, and this was the first decline in retail sales since December 2022. However, on a positive note, the data showed that retail sales in goods and services combined recorded a growth of 2.8% over the first 5 months of 2026. Over to the Far East, where on Tuesday the Bank of Japan raised its policy rate by 25 basis points to 1%, which is the highest it's been in over 30 years, and accelerating policy normalization, which started in 2024. This was the Bank of Japan's first rate hike since December 2025, when it raised its policy rate to 0.75%, and the first time since 1995 that the policy rate has been raised to this level of 1%. The policy tightening comes at a time when Japan has been struggling with a weak yen and inflation that has started to creep up, partly due to the Iran war. The central bank said that it will continue reducing its government bond purchases by 200 billion yen per quarter, that is until April 2027, when it will maintain its monthly bond purchases of 2 trillion yen. Even after deploying more than $72 billion in foreign reserves to prop up the yen, and the Bank of Japan raising policy rates to more than a 3-decade high, the yen is still languishing at around 160 yen versus the US dollar. On Wall Street this past week, US stocks rose on Thursday, staging a comeback after the Federal Reserve indicated the possibility of a rate hike this year, a move that sparked a sell-off in equities during the previous session. Wall Street sold off on Thursday after the Federal Reserve's first policy meeting, with Kevin Walsh as chairman, raised concerns about the future direction of monetary policy. The dot plot survey undertaken by policymakers but snubbed by the new chairman revealed that 9 out of 18 committee members now see interest rates increasing in 2026. The stock market closed out the holiday-shortened week in positive territory, with the S&P 500 gaining by 0.9% for the week for its 11th winning week out of 12, before closing at 7,500. Meanwhile, the Dow Jones Industrial Average advanced by 0.7% during the past week and was up by 72 points on Friday before coming to a close at 51,564. And last but not least, the Nasdaq Composite jumped by 2.4% on Friday and climbed by 1.9% for the week to finally close at 26,517. And in related news, on Thursday last week, the SpaceX IPO raised an initial amount of $75 billion, making it the largest IPO in world history. According to an investor relations update released on Monday, the underwriters of SpaceX's initial public offering have officially exercised the greenshoe option, increasing the total amount raised to $85.7 billion. As part of the greenshoe option, SpaceX's underwriters, which includes Goldman Sachs and Morgan Stanley, had the option to buy an additional 83.3 million shares. For your information, a greenshoe option is a provision in an initial public offering agreement that allows the underwriters to sell up to 15% more shares than was originally planned if investor demand is exceptionally high. And in the U.S. government bond market, the yield on the short-dated 2-year Treasury note rose by more than 16 basis points on Wednesday following the conclusion of the Fed's fast policy meeting and the chairmanship of Kevin Walsh, in which the committee voted to keep rates on hold but signaled a possible rate hike later this year. The yield on the 2-year Treasury note, which more closely tracks short-term Federal Reserve interest rate policy, gained by more than 1 basis point on Friday to close at 4.17%. Meanwhile, the yield on the benchmark 10-year Treasury bond, which is a benchmark for mortgage lending, auto loans, and credit card debt, this dipped by 1 basis point to settle at 4.45%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions. And in the commodity markets, where Brent crude oil prices rose on Friday after talks between the United States and Iran, which were being held in Switzerland, were abruptly called off, underscoring lingering uncertainty over efforts to turn an interim agreement into a lasting peace settlement. The White House said that Vice President J.D. Vance was no longer traveling to Switzerland, citing unresolved logistical issues surrounding the negotiations, but confirmed that oil tankers carrying more than 12 million barrels of crude oil had crossed the Strait of Hormuz overnight. Analysts are predicting that oil prices are likely to trade between $75 and $82 a barrel in the near term. And on Friday, we saw Brent crude, which is the international benchmark, gain by 0.9% to close at $80.57 per barrel, whilst the U.S. benchmark, West Texas Intermediate crude, traded higher by 1.23% and finally settled at $77.54 per barrel. In the precious metals market, gold prices fell on Friday and were on track for a third consecutive weekly decline as a stronger U.S. dollar and hawkish signals from the U.S. Federal Reserve weighed on the non-yielding metal. 9 out of the Fed's 19 policymakers now believe they will need to raise the policy rate by the end of this year. The resurgent dollar, powered by the Fed's hawkish tone, has stolen the spotlight and effectively neutralized the geopolitical tailwind that was pushing up the price of gold, reminding everyone that monetary policy still calls the shots, especially with regards to the price of gold. And towards the end of the week, the price of spot gold was down by 0.9% for the week, and eventually came to a close at $4,184 per ounce. And in related news, based on the annual Central Bank Gold Reserve Survey that is prepared by the World Gold Council, more central banks are now opting to store their gold reserves at home as they project that they will be buying more gold given its safe haven status amid the heightened geopolitical tensions. According to the survey, central banks have bought an average of 1,000 tons annually over the past 4 years, which was double the annual average over the previous decade. Despite the recent pullback in gold prices during the Iran conflict, the survey found that monetary authorities still consider gold as a key hedge against inflation, geopolitical shocks, and currency risk. And a quick overview of the African financial markets, starting off in Nigeria, where data from the National Bureau of Statistics shows that Nigeria's headline consumer inflation rose for a third consecutive month in May, edging up to 15.93% on a year-on-year basis, and this was up from 15.69% in April. Inflation in the West African nation began rising again in March after the U.S.-Israeli conflict with Iran drove up global energy prices. Price pressures in Africa's most populous country had previously eased for 11 straight months. The central bank said in May it expected uptick in inflation to be temporary. And over to South Africa, where the South African rand was flat on Wednesday after data showed that inflation in the month of May rose less than expected, which analysts said reduced the likelihood of another rate hike next month. Headline inflation quickened to 4.5% year-on-year in May, up from 4% flat in April, and was the highest rate since July 2024, driven mainly by fuel prices linked to the war against Iran. Economists expect inflation to rise further to nearly 5% in June, driven by higher fuel prices, before easing in the second half of this year. As a net fuel importer, South Africa is heavily exposed to the spike in global energy prices. We now change scene to the Kenyan financial markets, where during the past week, the Kenya shilling continued to trade within a narrow range versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.55 compared to a rate of 129.37 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.62 and the euro was valued at 150.18. And on the regional front, one Kenyan shilling was changing hands for 28.13 Ugandan shillings and 20.28 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.30. Despite the war against Iran and the subsequent increase in oil prices, the Kenya shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $91 million for a grand total of $13.14 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 28 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 18th of June, and the central bank received bids totaling to 48.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 204%. The central bank accepted 35.7 billion shillings, and the results of the auction were as follows. The 91-day rate ticked up by about 11 basis points to settle at 8.82%, whilst the 182-day rate shot up by more than 17 basis points to close at 8.77%, and the 364-day rate inched up by 10 basis points to average out at 8.97%. Over the past few weeks, the yield on the short end of the Treasury bill market has been rising steadily, and this is on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. And in addition to that, the latest data shows that inflation is now trending higher, mainly due to the impact of rising fuel prices. We should therefore expect more upward pressure on interest rates as investors park their funds into the 91-day Treasury bill, which gives them an opportunity to reinvest at a higher rate in the short term. In the primary bond market, the auction for the two reopened fixed coupon Treasury bonds was held on Wednesday, the 17th of June, and the central bank received bids totaling to 77.6 billion shillings against an advertised amount of 60 billion shillings, representing a performance rate of about 129%. The central bank accepted a total of 42.5 billion shillings, and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2018 and now has 11.8 years left to maturity the central bank accepted 19.5 billion shillings at a weighted average rate of 13.98% compared to the bond's coupon rate of 13.20%. And for the second bond, this is a 25-year bond that was initially issued in 2021 and now has 20 years left to maturity. The central bank accepted 23 billion shillings at a weighted average rate of 14.86%, and this is compared to the bond's coupon rate of 13.92%. Up next is our topical issue, and this week we're looking at diaspora remittances. The inflow of remittances to Kenya totaled to $394 million in May 2026, slightly down from $397 million in April 2026, a decrease of just 0.9%. Meanwhile, the cumulative inflows for the 12 months to May 2026 totaled to $5 billion, which was down from $5.03 billion for a similar period in 2025, which was a decrease of 0.5%. The inflow of remittances to Kenya remains a major source of foreign exchange earnings and continues to support the country's balance of payments as well as the domestic foreign exchange market. And in related news, in the 12 months to May 2025, Kenyans living abroad sent home about 280 billion shillings in unrecorded remittances that was sent through informal channels. A new official survey of diaspora remittances into Kenya shows that the total inflow for the 12 months to May 2025 stood at 931 billion shillings, and this was inclusive of remittances sent using informal channels like Hawala and cryptocurrencies. The amount received through formal channels like banks, mobile money, and remittance service providers during this period was 651 billion shillings, which implies that 280 billion shillings was sent using informal channels. This survey was carried out by the Kenya National Bureau of Statistics in conjunction with the Central Bank of Kenya and the Financial Sector Deepening Kenya organization. This was the first comprehensive nationwide assessment of household remittances in Kenya. Some of the informal channels preferred by Kenyans in the diaspora include in-person delivery when they visit the country, as well as the Hawala system and through cryptocurrencies. The main motivation for using these alternative channels was attributed to the lower cost of transmission, speed, and the ease of access. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this channel, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, it always seems impossible until it is done. A quote by Nelson Mandela. Think about it. Thank you, and God bless.